Hey there, and welcome. So you're ready to start investing, but you look at all the options out there and, man, it feels overwhelming. If that sounds like you, you're in exactly the right place. Today, we're going to break down exactly how to pick your very first exchange-traded fund, or ETF. Let's get right into it.
You've got literally thousands of ETFs staring back at you. It's no wonder so many people just get stuck, right? It's called analysis paralysis for a reason. You know you want to do something, but where do you possibly start? Well, don't worry, we're about to cut right through all that noise with a really simple, powerful framework.
Okay, before we get into the nitty-gritty of how to pick one, let's just spend a minute on the why. You got to understand why ETFs are such a fantastic tool for investors in the first place. Once you get this, you'll feel way more confident that you're on the right track. For millions of people, these things have been an absolute game changer.
So here's the magic, in a nutshell. With just one click, you can own a tiny piece of hundreds, maybe thousands, of companies all over the world. That's instant diversification. Plus, the fees are incredibly low. We're talking a fraction of what old-school funds charge, and you can buy and sell them as easily as a share of stock.
And for investors in Bulgaria, listen up, because this is a huge bonus. When you trade ETFs on a regulated stock exchange inside the European Union, the tax you pay on your profits, your capital gains, is zero. Yep, a big fat 0%. That is a massive advantage that can seriously boost your returns over the long haul. This whole idea really comes down to one of the most powerful concepts in all of finance. The Nobel Prize winner Harry Markowitz famously called it the only free lunch in investing. The idea is super simple. When you spread your money across lots of different things, which ETFs do for you automatically, you lower your risk without having to give up on potential returns.
All right, pay close attention, because we're at what I think is the single most important idea in this entire explainer. Seriously, getting this next part right is what separates people who succeeded investing from people who are just, well, gambling. It is the golden rule. Strategy first, tools second.
Think about it like this. You wouldn't just grab a hammer and start swinging without a blueprint, right? You need a plan first. An ETF? That's your hammer. It's an amazing tool, but it's only useful if you know what you're trying to build. Way too many people ask, what's a good ETF to buy? The real question, the better question is, what's my strategy and which ETF is the right tool to help me build it?
So, what on earth is a strategy? Don't let the word scare you. It's just your personal game plan. It's you deciding what you want to own. For instance, a really common strategy is to put 60% of your money into a big mix of global stocks for growth, and then the other 40% into bonds to keep things a bit more stable. After you decide on that plan, then and only then do you go looking for the right ETFs.
Okay, you've got your strategy figured out. Now comes the fun part, the how. We're going to use a super simple 4-part checklist to filter through those thousands of ETFs and zero in on the perfect one for your plan. This is your practical guide. So here are our 4 filters. First, we'll look at what the fund does with its profits. Second, is the fund big enough to be safe? Third, how does it actually copy the market? And finally, who's running the show? Let's break each one down real quick.
First up, this is a big one. What happens with the dividends? Accumulating ETFs are kind of magical. They automatically take those profits and buy more shares for you. That's your money working for your money. Compound growth on autopilot. Distributing funds, on the other hand, pay you the cash. That cash then just sits there doing nothing, which we call cash drag, and it might even cause you a tax headache. Bottom line, for long-term growth, accumulating is pretty much always the way to go.
Next up, size. And yeah, it matters. You really want to look for a fund that has over 500 million euros in it. Why? Well, it's a strong sign that lots of other investors trust it, which means it's easy to buy and sell. Plus, there's way less risk that the company will just decide to shut it down one day. So yeah, stick with the big ones.
Okay, this next one sounds a bit technical, but I promise it's not. Physical just means the fund actually goes out and buys the real stocks from the index it's tracking. Simple, transparent, and safe. Synthetic, on the other hand, uses a complicated contract with a bank to get the same return. This adds something called counterparty risk, like what happens if that bank gets into trouble. For peace of mind, physical is definitely the way to go.
And finally, who's behind the curtain? You want a brand name you can trust, right? Companies like iShares, which is part of BlackRock, Vanguard, Xtrackers, and SPDR, these guys are the heavyweights. They've been doing this for a long time and have a rock-solid reputation for being reliable and secure. It's a simple check that adds a lot of safety.
So let's pull all that together into your quick reference cheat sheet. You're looking for an accumulating fund for automatic growth that's over 500 million euros in size for stability, uses physical replication for safety, and comes from a major provider you can trust. See, if you just apply these 4 filters, you'll slash through like 90% of the junk out there, leaving you with just the good stuff.
And just one last, super important reminder for investors in Bulgaria. To lock in that amazing 0% tax on your gains, you have to make sure you're trading on a regulated EU stock exchange. A place like Germany's Extra is a perfect and very popular example that ticks that box. Don't forget this part, it's key.
So there you have it. Your checklist is ready to go. You have the tool to find the right ETF. But that brings us right back to that golden rule, doesn't it? Knowing how to pick the hammer is great, but the real question is, what are you planning to build with it? Is your strategy clear?